Hey, welcome back to the show, Total Financial Solutions, Save for Money Hour. That means keeping your money protected from the market. Look, part of what you got to do is figure out, what am I going to do with my retirement accounts? Look, you can have them at risk. You can put them in a place where if the market goes up, you make lots of money if you pick the right one. But if it goes down, you could also lose lots of money if you didn't pick the right one. And so people say, well, you know, my broker's a really sharp person. Well, that's amazing. That's great. I'm glad you like them, and I'm glad they're smart, of course. But at the end, what do they know? I mean, honestly, it's a question. I don't know the answer. I don't know your broker person. But what do they know? Are they out there, traveling to China and looking at the factories and looking at the fields in the Midwest to see if the corn production is up, or looking at the numbers and researching the price and the currency fluctuation? I don't know any of that. And they'll tell you, and this is all came from both the 2000 and the 2008 crash, they'll say, we relied on our research department. Okay. So that means they gave them information. So why is it that a majority of the accounts that we have encountered when people come to us and they say, I have an account with XYZ broker or brokerage company or whatever, why is it that a majority of the time that I've seen it, those accounts are in the funds that are under the proprietary name of that? In other words, if it's XYZ company, it's XYZ Municipal Bond Fund and XYZ International Growth Fund. Well, there's 11,000 different funds out there. You're telling me that out of the whole world, these happen to be some of the best? Or could it be that some of the brokers have told me, privately and some publicly, that 60, 70% or more of the assets have to be in the company's proprietary products? What that means is they limit the options that this, quote, smart broker can do. And they put them under places that just, look, you could throw a dart at a board and get some of these returns. So I want you to be careful. Protect your money. This is your money. It isn't mine. It's not your broker's. It's not the company's that you used to work for. If it has your name on that statement, it is yours. Don't let these brokers fee it to death. Don't let them charge all sorts of crazy fees. I'll give you an example. Just today, one of the accounts we looked at had a 3.5% fee.
Wow.
3.5%. Now, he has $1.4 million that he deposited in the account. It's a lot of money. He inherited it. Of the 1.4 million, okay, 1.4, the value today is 1.3 and change. So he's lost about 110,000. Not only did he lose 110,000, but they charge him 3.5% on the 1.4. Just to be clear, by the time it's all said and done, he pays around $50,000 a year in fees. Now, you might say, wow, well, somebody out there is buying and selling. Well, what's the difference if I buy and sell 100,000 versus $1 million? It's just a zero. Should I be paid an extra, I don't know, $40,000 to add a zero to a form? Add a zero. Because that's all the work the broker does. They're not doing anything. Look, I don't know your broker, so this is general, but figure this out. What the heck are they doing for $50,000 a year? You better not be golfing between the time the market's open. You better be taking trips not to go visit family or friends, but you better be taking trips to make sure my money is protected and safe. And most of the time, these poor folks don't do it. So I want you to be safe. Make sure that you're protecting your money. Make sure you can put some in a place where it's protected if the market goes down. That's true diversification. That's why our practice is about safer money. There's some good guys out there that do what we do. There's some great folks, fine. Find somebody that you like and trust. But you should not be paying, in my opinion, any of these fees. You shouldn't be paying income rider fees. You shouldn't be paying any of that baloney. It's all just, in my opinion, a little bit of a trick. I use that word loosely, but you can figure it out.
Well, and you have to take a look at, you're talking about whose money this is, and in how many cases, probably countless at this point, but I hear more and more how many times you're uncovering that the broker or the company charging the fee has made as much, if not more in some cases, than the return that's been brought to that person's account. Meaning someone has X amount of money in their account, they've made X amount, yet On the other side, if you add the fees that they paid, it's basically double the return. And something else that's really fascinating to me is that we're okay with being sold on the idea that the charge of the fees, the commissions, whatever have you, that comes out of our money, that we, when we deposit into these accounts or we make these investments, that money comes out first. So you're already in the hole, whatever that fee is, and you have to earn even more than that to get that back.
Yeah, look at some of the differences. Here's the way Wall Street has treated us as investors for a very long time. If you put $100,000 into an account, I know we're going to do math, and it's a little early maybe for math, but follow me for just a second. I'm going to keep this simple. If you put $100,000 in an account, and this year you lost 50%, 50. It's done that many times in our lifetime. 50. Okay. You lost 50%. That means your $100,000 is now half, or $50,000. If next year the market goes up 100,000 or 100%, in other words, you double your money back to 100,000. That's amazing. That's great. So you have a 100,000 plus and a 50,000 or 50% negative, right? So you've made 100%, you lost 50. What's the math on that? That means you're still plus 50%. But over 2 years, so let's divide that average rate of return. The average rate of return now, 50 divided by 2 is 25%. You would get your broker statement and those fancy prospectuses, and they would say, our average rate of return over the last 2 years is 25%. You go, wow, that's pretty darn cool, 25%. And you look and you go, but wait a second, my balance is the same. Yeah. How is my balance the same? Look, I tell my kids, look, you have to get a college degree. Those are important things. I love it. I need you to learn. Be in that environment. All that matters. But if you want to be successful and wealthy financially in your own life, I don't care what you choose to do, you better understand addition, subtraction, multiplication and division, decimals, fractions, and percentages. That means a statistics class, an algebra class, a basic math class. Those are so much more valuable than quantum physics. I love quantum physics. In fact, I really loved physics. But that has nothing to do with healthy, wealthy, successful anything unless you're going to be building bridges or unless you're going to be trying to figure out how to get us onto Mars. You want to run your day-to-day math, your checking account, your financial retirement accounts, making sure that your financial professionals are not messing around with your money, then learn those things. Addition, subtraction, multiplication and division, decimals, fractions, and percentages. That's it. Not calculus. Love it, but that's not needed.
Well, I think you've said it best, because all these people that are brilliant are still paid in dollars.
That's right.
That's the most important thing to remember. You're paid in dollars, not in any denomination of anything you deal with in your industry or your job. You are paid in dollars, and we all have to manage it better than we did yesterday. That's a really big deal. So I think going back to where it makes sense to start diversifying some of your retirement strategies, it's not always in the vehicles. We started the conversation with a Roth IRA. I brought the idea that some of these things may not always be around. The Roth IRA was invented to help raise tax revenues today.
Yeah, in the 1990s.
That's right.
You remember how they said, we balanced the budget? That was one of the strategies they used, was to keep you from putting money into traditional IRAs and 401ks, and the Democratic president and the Republican Congress got together and said, we're going to create this Roth IRA so that we'll tax the money today, and for the people, they're going to defer that tax at a later date. So that's what they did, and that's how they kind of structured it to build a way to keep that money from being deferred at a later date for tax reasons. Well, that's great, but you got to pay the piper sooner or later.
That's right. Imagine going to work, you put 100% of your effort out, and then 90% is put in your 401k. I think a lot of people can identify with that. They'd go, wow, I did all this work, I only have 10% of the money. Well, you're going to get it down the road. Don't worry. In 20 or 30 years when you retire, you said, look, I need some money today. So that's what the government did. They proposed something where people were putting money into a vehicle, they get the benefit later, they being the investor or the saver, but the government gets the money today. Now, you were bringing up something really important earlier, Arif, talking about the administration now, whether it's just the president or his cabinet, whatever have you. They have the Roth IRA. At least there's a big target on the Roth IRA. A lot of changes are coming down the pipe for that, or potentially, because people are really getting savvy with this. They're putting money away more and more in these post-tax accounts like the Roth IRA, and they're getting out of the government's pocket altogether.
Yeah, last September, Jeff, the president's job is to propose the budget, and Congress's job is to vote, move stuff around and vote on it. The proposed budget from President Obama last September included eliminating the Roth IRA as an option, as one way to raise tax revenue. So it is on the radar screen it was voted down by the Republican Congress, but that's just a political thing, right? That means the next time you have a Republican president and a Republican Congress, if they propose that, it's probably going to go through. So you don't know what's going to happen. I said if. Some of you are smiling. If, or, cross your fingers, people. We got to save this nation. It could be Hillary.
Could be.
That would be fun. We got to have a saying. I don't know. I got to think of one. I'll think of one that's not mean or rude, but just more accurate.
Okay.
Something like, "Don't be telling me a Hillary. Did you really clean your room, son?" Make it
see what you did there.
Synonymous with lying. All right, so listen, we're going to take another break here in just a minute, but I want to keep focus on one more thing. There are some retirement moves you can still make in 2016. We don't know what's going to happen with the political landscape. A lot of things are changing. Within that whole world, you're going to find a couple of things happen. One of those is you have control over certain financial things that you do in your life. Those things that you do, that control, has to be proactive. In other words, you have to do these things. You can't expect somebody else to do them or wait until my next pay raise or wait until the kids get off school or back to school. No. You have to start taking action. When we come back, we're going to give you a few steps here that will help you at least take the next step. I'm Arif Halaby. That's Jeff Girard on Total Financial Solutions Safer Money Hour on your place for news, talk, and information. This is your hometown station, AM 1220 KHTS. Hey, welcome back to the show. Total Financial Solutions Safer Money Hour. Arif Halaby and Jeff Girard, your place for news, talk, and information. All right, we've got some smart moves, some things to do financially speaking, of course. In 2016, I know we're about a third of the way over, or maybe quarter of the way over, I guess, 25%, three months. Is there still something you can do, first of all, for 2015? Yes, there is. April 18 is the day in which you have to file your taxes. There's some weekend and holiday stuff and some rules that pushed it out from April 15 to April 18. So it's good for you to know that. You got a little bit of time. But you can deposit money into a traditional IRA or a Roth IRA up until that date for the previous year. In other words, it can be money that you just earned last week, and you can count it towards last year's income and give you a reduction on the income, or count it towards crediting for your $5,500 if you're under the age of 50, so 49 years or younger. But if you're 50 years or older, you can do $6,500, and there's still time to deposit for that. And if you are a small business owner, you can actually put money into a retirement account as well for you for last year, putting it in under today's money as well. You can give us a call. We'll help kind of walk you through that at Total Financial Solutions. You can go to hometownstation.com, click on Total Financial Solutions, or better yet, let me give you our phone number. It's a simple number, 753-9683. That's 753-9683. Of course, you can get a hold of us. All right, 2016, still time left. Jeff, can I do anything to boost my retirement in this year?
Well, I would say don't forget that if you have a stay-at-home spouse and you have earned income and you've got more than $5,500 or more than $6,500, you can still make that contribution on your spouse's behalf and still take that deduction. Of course, you want to check with your CPA. There's some rules. You probably have to file, whether you're filing separately or joint, that can all impact all that. So check with your tax preparer. We're not tax advisors. We just understand tax law and tax rules. So don't forget your spouse when it comes to that extra contribution, because it does a couple different things. If you're looking for the deduction, you can probably take that as well. Plus, you're bolstering your retirement, because if you're married and you have your finances together and you make a contribution on behalf of them, it's basically all going into the same bucket. So for folks that are saying, wow, I bumped my head at $6,500, where else can I put money? I don't have a retirement account at work. Look at that spousal IRA. Now, there's no joint IRA. You'd have to make two different contributions, two different accounts. One would be under yours, one under the spouse, but like I said, it's all under the same household. So that's one way to either reduce your taxable income potentially, or fund another Roth IRA and have more money on the tax-free side of things for your retirement.
Yeah, remember the I in the individual retirement account, that's what it stands for, is the I as an individual. So, part of that plan, if you will, is to say, I have mine, my wife has hers, or I have mine, my husband has his. Those kinds of things exist independently, so don't combine them. And think that that's yours, or that you can't put money in because your spouse did. In California, you can't move it unless your spouse agrees. For the most part, you have to have them sign things. But the idea of building and continuing that savings part is important. You may receive a pay raise this year. If you're one of those fortunate people to actually receive a pay raise or a bonus this year, you can designate some of that off to the side for retirement savings. In other words, if let's say you receive a 2% pay raise, you can increase your retirement savings by 2%. So in other words, it comes in the front door and goes out the back. You live the same way as you did last month, but you actually are now putting money aside for savings. It's a way to slowly build up your retirement accounts without necessarily impacting the way you live every day. That's one option, and you still have time to do that. Even if you did already receive a pay raise, there's still time to walk in to your HR department and ask if you can increase your contribution. You should be able to, and make some adjustments there. What about debt, Jeff? Sometimes we seem to let that get out of control.
That's true, and I think people forget that there's a phantom rate of return, so to speak, in paying down some of that debt. Now, if you have $500 a month that's going out to pay for credit cards or maybe some personal loans and whatnot, that's $500 you don't have each and every month. If you found a way to pay down that debt by either accelerating it or taking a tax refund or a big bonus that you may have received from your employer, or maybe extra money from a small business that you have on the side, any way to reduce that debt on the side and eliminate that $500 going out the door to somebody else other than your savings or paying for your current expenses or your lifestyle, that's a pretty big boost. And I think people get into that quagmire very, very slowly over time, and then they don't realize that, poof, one day they wake up and there's $500 or $1,000 leaving their finances, leaving their pocketbook every single month to go pay for whether it's credit cards or personal loans. Like I said, bring that back in-house. There's a way to do it. We've given you some tips on previous shows. If you want to download some of our old podcasts, we've talked about how to systematically pay down bad debt. I mean, we've also talked about the difference between good and bad debt, but let's just talk about some of that recurring credit card debt that you've got out there. Take that down systematically, get it paid off sooner than later, but don't do it at the expense of not paying yourself first. I want you to save for retirement and pay down debt simultaneously. If you have a short-term plan to maybe halt some of that retirement increase like we're talking about, so let me back up a second. If you have a choice to say, look, I want to get my debt under control, but I also want to increase my retirement savings, you may hold off on increasing it, but keep it where it's at. So if you're saving $100 a month or $500 a month or $1,000 a month, you may not increase it, but I want you to keep saving that. Any extra money, whether it's that raise or that bonus, you can start paying off some of that debt. There's a systematic way, like I said, to do that. Get that paid down. Now that amount of money you were paying into debt, you pump that into your retirement savings. Now that is a huge, huge bump. And that's a plan. That's not just doing things by accident. That's doing things on purpose and then putting money back in your pocket.
And the ideal part of this process is to know that it's going to take time. And more importantly than saving $100 or $1 million or whatever it might be in your life is to change your habits so that as you're saving money, you're spending less, so that you now have a habit of actually moving forward financially and not getting yourself into trouble just because there's a pay raise or job loss, right? If there's a hiccup financially, I don't want that to be something that just throws your whole financial life upside down. Realize that habits are key to every part of your life. Habits are key to the way you eat. Look, think of it like this. If I wanted to lose 20 pounds and I didn't eat at all today, would I lose 20 pounds? Of course not.
No.
If I wanted to gain 20 pounds and I just ate an entire chocolate cake right now, would I gain 20 pounds? Of course not. These are habits. Right? Every single day, if I wanted to lose weight and I just ran around the whole block, ran for 10 miles and didn't eat, you're not going to, it's systematic. Well, being wealthy or successful or financially on track and getting your debt under control is also a very systematic, steady, hobby-filled life. So be patient with yourself. Reward yourself along the way. Give yourself a good attaboys, because sometimes we're the hardest on ourselves than anybody else. But realize that you're part of a process of changing something that you screwed up on. I mean, you got to acknowledge that.
Yeah.
Unless it's a big medical thing or a divorce or somebody passed away and it was all, all of a sudden, and life didn't, work so quickly and easily in your favor, but against you, well then, look, the same thing. You have to go, all right, how do I build from where I am? It can happen at any time to anybody. And the process of building those little safety measures in place, like emergency accounts, like systematic savings, like leaving some of your debt, or if all of it, but you have available credit card that you can access at any time. Oh, you need something big, you can use it from your savings, or you're not maxed out on your house mortgage every time you refinance and you refinance and you refinance, right? All of those things in and of themselves are not evil or bad, but are you doing it with a plan? Does it integrate with your CPA or your financial professionals or your attorney if you have a business, and you're putting all of this stuff together? That's where we miss. You think you're supposed to be good at everything, right? Ask the women that have gone to the workforce and they're telling us, oh, you can have it all. Well, look, I don't think you can. There's some wonderful authors out there that are saying things like, look, you can't have it all. Right? I can't be a dad who is around my kids 24 hours a day and working 24 hours a day and honoring and respecting my wife 24 hours a day and my business 24, right? There's just not enough time. So something has to give. And it's the same thing financially. If you get as close to balance as you can, and you get to the place when you say, and now I'm going to start saving a little bit more, well, you're going to be spending less. There's no such thing as a perfect balance. It takes time.
Well, and some of the best books, I think, are written on that exact word, balance, but that's not sexy. People go, I want to have it all. That's what people want. There has to be a gimmick. There has to be a way, a magic wand. Well, there really isn't. It's systematically having your life in order, and it's something as simple as a budget. A budget is a four-letter word to some people. They say, oh, that tells me how much I can't spend. A budget tells you exactly what's coming in, where you are with your inventory, basically. What are you paying out each month? And it's an eye-opener. For a lot of people, doing a budget is the thing they don't want, because now it's bringing up all the spending ills. If you start to see the $3 a month here, the $11 for this, and these little subscriptions, and the gym membership, and all these things that you're paying out that you're really not getting any fulfillment out of, it's just another place to spend money because it was cool 10 minutes ago or last month, you're going to start to see that all of that adds up, and that chunk could mean you're paying off an entire debt. It could mean that you have an extra payment towards your retirement account at work, and maybe you get a match there, and maybe your employer says, here, whatever you put in, we'll match a percentage of that. Now you're getting free money instead of having money go out the side door and you don't even realize it's going there. A budget's a great way to get your finances in order, but a lot of people are timid and they're scared of it. It takes time. You have to catalog all of your spending. I mean, what comes in, if you have one or two jobs, is a fairly simple process, but where all the money goes, that's a bit of a daunting task for a lot of folks. Now look, with the way smartphones are and integrating our banks with that, you can pretty much, the tools are abundant, the resources are out there. You just have to take the time to sit down and do it. Family meetings are great too. It's a great way to get all that wrangled and have at least a handle on what's going out of the house financially.
And look, you can always come to some of our dinner workshops. We have them monthly in different places, but sometimes we're over at Salt Creek Grill. Sometimes you can see us at Lucille's. If you're in the Santa Clarita Valley, if you're over out in the Antelope Valley, try Fresco too. We have a wonderful dinner there. And they're kind of up-to-date things that are happening a little bit, why we think the market is doing what it's doing, and some of the options. More importantly, forget that craziness. What about your life? Are there some things you can do? Great. So we have clients and prospective clients come and learn a little bit about what we're doing, and you get a great meal. I love Salt Creek Grill. The food is actually, one of my favorites. It's where I spent Easter morning, actually, at brunch.
Nice.
Nice place.
Well, and it's a nice, relaxed environment, too. I like how you present these because there's a relaxed sense of talking about what's possible versus what you think people should do. And we can present options, and really it doesn't matter what the market is doing if you don't have your household finances right here in front of you taken care of. If you're not able to save for retirement and then keep it in a retirement account, which I think is really important, because here's what I see a lot. People say, oh yeah, we're handling our debt, we're handling our retirement, great. And then 6 months, 6 years sometimes it takes, someone comes back and they say, oh, we need to liquidate our IRAs, we need to liquidate or take a loan on our 401k. Why? Well, because we have to pay off this credit card debt. We can't even make the interest payments anymore. Or we took this second on the house, or this third, or you know the story. You know who you are and how it works. It all of a sudden happens, and then you have to liquidate your savings. So you spent all this time and effort putting money away that you did not spend. You took it out of your pocket and put it aside for your future. What you thought was 20 or 30 years from now, but it ended up being 20 or 30 months away because you didn't handle the credit card side or the loan side of things.
Yeah, and your family's financial life is going to be contingent on you making more good decisions than bad decisions. It isn't always making the right decisions, because sometimes you're going to just learn and you're going to be stuck. Remember retirement accounts. To recap today's show, retirement accounts, consider the Roth IRAs. Consider the Roth 401ks, because did you know if your retirement account at work has a 401k, which is pre-tax money, you can also ask, and usually they have, a post-tax 401k as well. Now, the total amount you can put in is the same number, but you can split it half and half, or however you and your professional financial team. And you might laugh at that and say, well, that's me and my daughter, or me and my husband. Well,
right.
You need to bring in a financial professional. Maybe it's your CPA. Maybe it's us. Maybe it is a combination of people where you sit down and you go, okay, what does this do to me? Should I put more here or less there? What's my matching? What am I receiving? And those things can help you determine the best place to put some of that. But secondarily, we're talking about some smart moves to make in 2016. Jeff, we talked about saving money even if you get a pay raise.
That's right. It's a big deal. And you might think that pay raise is a taxable event, but if you're putting that into that retirement account, they kind of negate each other. Of course, check with your team, but there might be a chance that you're working more overtime this year than you've worked last year. You're going to need a strategy for that, because a lot of people complain, there's not enough overtime. Then they get overtime. Oh, I paid too much in taxes. Well, maybe you can still keep it, instead of in the right pocket, the left pocket, and that pay raise can go to your savings. And maybe you take a little bit and carve it out for debt like we talked about. There's always a little strategy there. Also, take a look at some of your health needs. The whole health insurance world is thrown upside down. You can expect the next president to make some changes, whether it's a Democrat or Republican. There's probably going to be some adjustments. Ours continues to go through the roof. I think I'm at 300% of what I used to pay. Sheesh.
I mean, do you understand that, folks? 300 times. I didn't get a 300% pay raise. We didn't suddenly have 300% more clients, right? I mean, we're just a small business like everybody in town trying to figure it out. So I think they're going to make some changes. They have to. It's just all broken up. But in addition to that, you're going to have to take a look at some of your residential needs. Where are you going to live? What is that going to look like? Start planning now, 5 or 10 years away from retirement. Take a look, whether it's time to buy a vacation home there, whether it's time to travel a little bit more around the areas that you think you might want to live. These are important things to build the next phase of your financial life. Remember, you retire, that first 10 years, you're going to spend a lot of money on living and taxes. The next 10 years, living and taxes as well. You're going to want to protect that. Thanks for listening. I'm Arif Halaby along with Jeff Girard, and we're here every week at this time talking about your family's finances. You can reach us again at 753-9683. That's 753-9683. You can also go to hometownstation.com and just click over on Total Financial Solutions. Thanks for listening again. Arif Halaby and Jeff Girard on your place for news, talk, and information. AM 1220 KHTS.